Broken Window Fallacy, a presentation by Nikolai. The broken window fallacy was first described by Bastiat Frederick in his book, translated from French by Patrick James Sterling, That Which Is Seen and That Which Is Not Seen. The fallacy is paraphrased as follows. Have you ever witnessed the anger of the good shopkeeper when his careless son happened to break a square of glass? If you have been present at such a scene, you will most assuredly bear witness to the fact that every one of the spectators, by common consent apparently, offered the unfortunate owner this invariable consolation. It is an ill wind that blows nobody good. Everybody must live. And what would become of the glaziers if panes of glass were never broken? It is basically just an observation that even though at the cost of the shopkeeper, a broken window is industry to a glazier. At the cost of $10 to fix the window, the shopkeeper loses that money that could be used to fix or improve his existing shop. Or it is profit that he can't use to pay for food for his family. On the other hand, the glazier, whose business it is to repair broken glass, takes the $10 from the shopkeeper. The idea of the broken window fallacy is that money that could be used for one thing instead has to be used for another. It argues that it is the opportunity for money and industry to flow. In the case of the shopkeeper and the glazier, it is very possible that the glazier will return to the shop for his food or general goods. Perhaps the most popular example of the broken window fallacy is the costs of war. Is war profitable? When applying the broken window fallacy, money that could be used for one thing is instead being redirected to another cause. In the case of war, money is spent in large quantities on the personnel, equipment, and training of armed forces. That money is lost on other government programs like schools or mass food production. Or in the case of single families, it is lost on food, clothing, or health care. Another example is that of a college student who's been saving up money towards the purchase of a car or vacation. If that college student's computer breaks at the end of the semester, that money that he's been saving for the car or vacation would then need to be used on the repair of his computer. All of these examples still lead to a circulation of money in the economy. Even in the case of war or the college student, it is harder to see where the money will circulate back to the original spender. But the ripple effect of all of these separate purchases is unperceivable. But every purchase or transaction in the world keeps the money and economy flowing. And that is the idea of the broken window fallacy.